Consumer Action's 54th anniversary virtual convening, stepping up to inform and protect consumers. I'm Nelson Santiago. I'm a community outreach manager with Consumer Action, and I've seen many of you at our webinars recently, and a lot of you in person this year, especially at our in-person events. Thank you so much for being here today, making time to be part of this discussion. Today's going to be a little bit different. We're going to do a deep dive discussion on the theme for the convening, stepping up to inform and protect consumers, especially now that there are some gaps in protection for consumers at the federal level. So as you can see already, we have a wonderful panel. They'll be introduced to you in a moment, and they are the right people to talk about this topic. Before we get into it, I do want to thank our sponsors for the virtual convening this year. They are Walmart and JP Morgan Chase, who have been longtime supporters of Consumer Action, and we are glad that they are committed to consumer education and supporting us this year as well. Today, we also will have a moderator, our very own Ruth Susswine, who is the Director of Consumer Protection at Consumer Action. She works out of the DC, in the DC area on advocacy, on consumer protection, financial literacy, financial empowerment, and we are so glad she's going to lead this discussion. One thing I do want to point out is that it is a discussion and we want you to be part of it. So use the question function in the GoToWebinar platform and submit your questions. We'll get these to Ruth so that she can present them to our speakers. At the very end, I'll come back. I'll say a few words about our event this evening, because today is this convening is part of our celebration. Today is a celebration of our 54th anniversary, and we have an event tonight. So if you're in DC, hopefully you've already heard about it and registered, but if not, I'll have a word about that at the end, and it's not too late. You'll also, if you could just hang on a bit at the end and give us a little bit of feedback on the convening, we'd really appreciate that. So Ruth, let me turn it over to you, and I'll stand by for questions too.
Thanks, Nelson. And thank you all for joining us today for stepping up to inform and protect consumers. And thank you to this excellent panel of experts that's going to help explain what states, localities, and nonprofits are doing to help consumers and communities cope with federal financial cuts, spikes in insurance premiums, healthcare and homeowner coverage losses, and attacks on consumer financial protection. But first, let me introduce our guest speakers. With us today is Andrei Vasilyev, Assistant Director of Economic Development of the New York City Comptroller's Office. Secretary Wendy Spiker of Pennsylvania. She's the Secretary of the Department of Banking and Securities. Kampf Desai is Senior Principal at the Cities for Financial Empowerment Fund. Anna Odegaard is the director of the new Minnesotans for Consumer Financial Protection. Commissioner Michael Humphreys is Pennsylvania's commissioner for their insurance department. Doug Heller is the director of insurance at the Consumer Federation of America. And Colin Roosh is the director of policy at Community Catalyst. Welcome all. For background on each of our speakers today, you'll find a link to their bios on our website. If we're to admit it, we've been living through quite an era of late, filled with a sense of uncertainty, insecurity, and for many, a lack of affordability. As you know, the federal government has been shut down for just about a month, leaving about 700,000 federal workers furloughed and about as many others working without a paycheck. And that does not count the contractors and other people who are affected by this shutdown. The shutdown has been focused on a fight over the expiration of tax credits that help make healthcare more affordable. Without these subsidies, Obamacare insurance premiums are expected to actually double or triple. That could amount to costing some families an extra $24,000 a year, and we will discuss some of that later. The federal government shutdown was the most recent significant disruption to our economy, but not the first. The New York Times has tracked 58,000 cuts since the Trump administration took charge in January. Budget slashed, federal grants frozen, and committed federal funds reneged on. Hundreds of thousands of federal workers eliminated already with threats of more to come. SNAP food benefits may be cut, and there's been a multitude of other firings. Inspectors general and commissioners that oversee federal agencies, all in an effort to reduce the role of the federal government. Some of these cuts will not be felt till next year, possibly even later, and others are beginning to be felt already, leaving people with less access to healthcare, health insurance, housing, even food. And while no state or federal locality can completely fill the gap that the federal cuts will bring, today we're going to examine what action local leaders, state governments, and nonprofits are taking to offer practical support and expand consumer protections to help cover these growing gaps at the national level. So I'd like to open by asking a few of you, of all the expected federal cuts, forcing states and localities to make some incredibly hard choices in the days ahead, what most concerns you for consumers right now? Commissioner Humphreys, can we start with you?
Yeah, absolutely. And thank you for having me. I think given today's date of October 29th, what concerns me most is that in 3 days from today, Saturday, November 1st is when open enrollment begins for health insurance purposes. And despite insurance commissioners' best efforts, despite consumer groups' best efforts in expressing to Congress just the true impact of what EPTCs going away will look like, to date, they have not responded. They have not extended these EPTCs that are going to expire as of today on December 31st. So when people in Pennsylvania, our state-based exchange is called Penny. So when they log into Penny on Saturday morning, is the first opportunity to see what their insurance premiums for 2026 look like. They are going to see premiums that on average increase 100% from where they are today. So that's completely double. Others will see far greater than 100%. And it's an event that was could have been prevented by congressional action that we've been talking about throughout this year. Rates went up in Pennsylvania by, we approved 21.5%. 3.5% to 5% of that is solely because EPTCs are scheduled to expire. So the expectation from insurance companies when they made the filings was that the risk pool would be worse in 2026 because the price is going to go up by so much. A significant number of Pennsylvanians are going to have to forego insurance. They're not going to be able to afford health insurance. They're going to make the hard decisions to pay their mortgage bills, to feed their family. And health insurance has to take third priority in that case, or fourth priority, or fifth priority. So we expect upwards of 150,000+ Pennsylvanians. Our exchange is 500,000 plus to come in to see premiums on November 1st that are too costly. And the challenge that really is one that we're looking at right now is I fear that once they come in on November 1st and see that premium, even if Congress acts 6-7 weeks from now, I think we all know that oftentimes Congress, when they have a deadline, doesn't act until the day of the deadline. If they extend EPTCs on December 31st, there will be thousands of Pennsylvanians that would have come, seen their premiums on November 1, and don't know to go back. I mean, the administration in Pennsylvania, we will do everything we can, regardless of when Congress extends EPTCs, if they extend EPTCs, to get that information out to consumers, to go reach out to them again, to tell them, come back, look at the price today. The price is now different. But so many people would be so discouraged on Saturday by the just significant premium increases that we fear that they're going to lose coverage. They're not going to have coverage for next year. And not having coverage doesn't stop the need for coverage. It doesn't stop the emergencies that will come up. It doesn't stop the need to go to the doctor. So it's just a spiraling challenge that I really, Congress has had enough time to make the right decision, and they still haven't done it. So I'm very fearful going into November 1st of what open enrollment looks like, what 2026 looks like, because of the rates that we're seeing and that consumers are going to see.
Thanks, Commissioner Humphries. And EPTC is extended premium tax credit, yes?
It's the enhanced premium tax credits,
Enhanced,
yes.
sorry. Doug Heller, will you tell us how you're feeling about what you're most concerned about for consumers right now?
Thanks, Ruth, and thanks so much for inviting Consumer Federation of America to join us. You know, Commissioner Humphries has taken on such an important point with health insurance. I spend a lot of my time working on auto and home insurance, which is actually governed by the states, which, you know, we would hope would give us some relief. But insurance is like no other product in the marketplace. Not only is it a key financial tool for individuals and family economic security, as well as community resilience, it is something that we are required to buy, whether it's state mandated auto insurance or mortgage lenders' requirement that you buy homeowners insurance in order to get a loan. Government has a special obligation to ensure that we can access and afford these essential products. But in state after state, we are seeing crisis level price hikes, shrinking coverage, and millions of uninsured drivers and uninsured homes, primarily in lower income communities, rural communities, and communities of color. And when Americans cannot afford to insure themselves, whether on the road or in their homes, it rattles our collective economic security. So I'm not most worried that insurance companies will use their market power to squeeze consumers as much as they can. I know they will do that. I've been watching it for the past 25 years that I've been watching this industry. What worries me most right now is that lawmakers and regulators in the states won't push back and hold this industry accountable, which is why we at Consumer Federation of America are so happy that you are creating conversations like this. We need to be working with our community groups and organizations around the country who are going to have to step up and begin to really communicate with their lawmakers and their regulators. Commissioner Humphries is a unique one. He's listening, we know that. But throughout the state, there are a lot of the country, there are a lot of regulators who have just not paid attention to the communities that we all represent or are concerned about. So I'm most worried right now that the regulators and lawmakers won't step in the breach that the insurance companies have created over the last several years.
Thanks, Doug. And Conf, what are you most worried about?
That's a really good question. And again, thank you to Consumer Action and all of you for inviting me to participate. We have been focused a lot on what cities and counties can be doing in this space. And in particular, one of the challenges is that, as we all know, vulnerable communities are vulnerable because of their financial insecurity. And I think this current time with all the various cuts is only going to cause more vulnerability amongst more communities. And now we don't have a functioning federal level consumer protection apparatus. And that just heightens the importance of what other actors can do in this space. And clearly it's going to be a all hands on deck situation. And so I'm concerned about what the financial innovation industry is going to do to try to theoretically help people, but invariably often causes more problems in the long run. And what that ultimately does to cities and their budgets and states and their budgets. And so we're paying attention to a lot about helping cities think about what can they bring to the table when it comes to basic consumer protection. It's been a challenging thing because a lot of cities just haven't done this in 40 years. And so, but I guess if there's a silver lining, now all of a sudden they're on the hook now of figuring out, well, how can they start protecting in a meaningful way their residents from predatory and deceptive business practices that target the most vulnerable people in their communities. And so that's what we're paying attention to a lot, what we're worried about. But like you all, the costs that are being borne by low and moderate income people are going to just get worse. And so we need to be cognizant of that.
Thank you, Phil. You mentioned vulnerable consumers. We're talking older Americans, limited English speakers, low and moderate income families. They're the ones that are most at risk of these extraordinary cuts, and they're the ones that are most impacted.
Yeah.
The current administration is working to lay off thousands more employees, and in some cases, they're looking to shutter entire agencies. USAID, Department of Education, and of course, as Conf mentioned, the Consumer Financial Protection Bureau, the CFPB. Since February, the CFPB has been gutted. Its budget has been slashed nearly in half, and there's an ongoing battle to lay off not 90% of its staff. The CFPB wrote rules to curb predatory practices. It oversaw large financial firms to ensure that the laws are being followed, and it sued the worst actors. And now the agency is nearly dormant. The Consumer Financial Watchdog, the CFPB, was created after the last great financial crisis, the Great Recession, to help inform, empower, and protect consumers from unfair and deceptive practices, to help expand access to financial services, and to offer consumers a place to go to file complaints, and to have someone who will hold big financial companies accountable when consumers complain. Well, the CFPB returned more than $21 billion to bill consumers, but now much of the Bureau's work has come to a grinding halt. But some states have made a point of picking up that consumer protection mantle, and Pennsylvania is one of them. Pennsylvania has stepped up to protect consumers with a centralized complaint system. So Secretary Spiker, can you explain how the Pennsylvania complaint process works?
Thank you, Ruth. And again, thank you for inviting us to be able to speak about the really good work that's being done in Pennsylvania. We're always happy to talk about that work. So when we were looking at what was happening at the federal level, we really wanted to get the message out that regardless of what does take place at the federal level, particularly the CFPB, Governor Shapiro wanted to reassure folks in Pennsylvania that we've always had strong consumer protection laws in place that govern the financial entities and the insurance companies. But more importantly, he also wanted to make it easier for folks to get the help they need when they actually need it. The Consumer Protection Initiative that was announced earlier this year follows his motto and his theme of his administration about getting stuff done. He uses a different word sometimes, but we'll stick with getting stuff done. He also believes that there should be no wrong door when dealing with state government. Consumers shouldn't have to know what agency regulates their bank, their mortgage company, or their insurance company. There should be a one-stop shopping approach, a single email address, a single phone number, or a single website to eliminate the guesswork and, frankly, the frustration that consumers feel when they're just trying to get help. The goal is to make it easier and faster to get them the help they need when they need it. I don't know about you, but I get incredibly frustrated when I'm shuffled from agency to agency, department to department, when I'm trying to find help, especially around things that are so important like finances and insurance coverage. Basically, the initiative triages the issue for the consumer and gets it to the right place, which speeds up the resolution process.
Great.
This confusion, I'm sorry, Ruth.
No, please.
I'm sorry. I just wanted to say the confusion is especially true around the banking system. For consumers, largely, they don't realize that there's a dual banking system in the US. So what does that actually mean? Essentially, banks and credit unions can choose who they want to be regulated by. They can pick a state charter or they pick a federal charter. For banks that are headquartered in Pennsylvania, we actually charter 80% of the banks that are headquartered here, and only 20%, but they are the larger ones, that are actually choosing to be a national bank charter. But consumers shouldn't have to try to figure out who the regulator is of that bank when they have a problem. So we have a really great team of consumer service specialists here at the department who field all of those inquiries. it's not, if it's not an entity, for example, that we regulate by, in our department, we work closely with the federal regulators who are not impacted. So the OCC, who regulates national banks, and the NCUA, who regulates federal credit unions, or the FDIC or the reserve banks, they have their existing funding. They're not necessarily impacted by the job cutbacks. But our team works closely with those teams in the customer service specialty area to make sure folks have coverage for consumer
So Secretary
protection.
Spiker, what are the kinds of complaints that you mostly hear from consumers about?
So our great team last year fielded over 8,600 calls, and they handled about 4,100 cases that are related to our actual entities. But when you look at what's coming through, about 50% of the complaints that come through are related to non-bank type of entities, the mortgage servicers, the installment sellers, the repossessors, things along those lines. 35% are actually related to banks or credit unions, and about 15% are related to securities. So if I think about the way we're broken out, those are the 3 regulatory program areas we have. If I look at each one specifically, like in the non-bank space, the primary complaints focused on money transmission and mortgage servicing. And I will tell you as an example, one of the reasons we saw a huge uptick in money transmission complaints is we recently had a money transmitter fail. That money transmitter was located outside the Philadelphia high density area. So we immediately pulled their license, we pulled down the bonds, but then the hard work really started. So we had to try to find out who was actually holding the worthless money order so we could get them the refunds. We did a huge mass mailing to residents within certain specific zip codes around that particular money transmitter. We also did a huge outreach to utility companies, large landlord or tenant associations, trying to get the word out that we had the ability to get them refunds for the worthless money orders that they were holding. Our team was really tremendous. They also worked with those utility companies and those landlord companies in getting the refunds if there were NFS fees or late fees associated with those bad money orders. I can tell you it's still an incredible lift, and our team is still doing heroic effort because we haven't located all of the holders of the money orders yet. After all the outreach that we're doing, we still have money set aside in escrow to make those refunds once we can actually find them.
That's great. Well, I'm glad to hear it. I'm sure Pennsylvania residents are glad to hear it. Commissioner Humphreys, can you talk a little bit about some of the top insurance-related complaints and what the department does to resolve some of the disputes? We can't hear you. We can't hear you.
Sorry about that. I think Doug touched on this a little earlier. Insurance is uniquely state-based. So the insurance departments across the country handle all sorts of insurance complaints, from the auto side to homeowners to health and life insurance. So we get a little bit of everything. At the end of this past September, we're already at 12,000 complaints from Pennsylvanians for this year. Last year, we were able to mediate complaints and returned over $22 million to Pennsylvanians as a result of our efforts. So typically the way the complaint process will work is we'll have an individual who's having a hard time with an insurance company. As an example, I could think of a complainant that we had from Avoca, Pennsylvania, who felt like they were getting the runaround from a life insurance company. They thought they were continuing to submit the information that was requested for the death benefit claim. They were due a death benefit of $500,000, but each time they reached the company, it wasn't something that they were getting anywhere on. So they reached out to our department. When a complaint comes in, it comes into our consumer services team. My consumer services team, depending on the complaint, sometimes we'll need some additional information from the policyholder. We'll go back, get policy numbers and that sort of thing. But then we'll reach directly out to the insurance company and say, look, we received this complaint. we have these concerns in addition to the complaint, send it out to the insurance company and give them some number of weeks. Typically, it's somewhere between 2 and 4. We expect you to get us a response on this complaint. In that case, we were able to get that $500,000 paid to that individual within that 2 to 4 week period, just because we were able to come in, make sure the information was the full information that the company needed, and the company was able to move fast to get that done. We have other situations where there's another complaint that was recently brought to my attention. An individual in Philadelphia had the parked car. Their parked car was hit. They needed a rental car for a period of time. The total loss was somewhere around $26,000, and the insurance company initially wasn't going to pay. They complained to us because it was, I don't know where else to go. My insurance company isn't making good on the promise of payment. That is why I purchased an insurance policy in the first place. They reach out to us, we reach out to the insurance company. That payment was made, covering both the total loss and reimbursement for rental expenses. So it's really a process where our team is here as a resort for consumers to have recourse when companies, and I'll tell you, 9 out of 10 times the company does the right thing. But sometimes companies do dumb things, and I tell them that too. I tell them, as my first rule of thumb, don't do dumb things. Sometimes we'll close 96% of claims after kind of a significant weather event. You're closing them within a couple of months. The consumer is satisfied, but there's some that last 8, 9, 10 months. What I tell them is, why aren't you looking back at those claims to say, what more can we do to bring resolution to this claim? Why is it on the consumer to go seek legal representation? Why is it on the consumer to come to us? You shouldn't be in that position, because, you know, when you have those outlier scenarios, those are the individuals that will talk to their legislators. They'll talk to their media. That's why we continue to have, I think, a tough image problem at times in the insurance industry, because you can do 98% of things right, but those 2%, if you do them really badly, it is a human interest story. It is a interest scenario. So we really serve a role of making sure that insurance companies are standing behind the promises to pay. Insureds pay thousands of dollars every year for our insurance coverage, whether it's homeowners, it's auto insurance, it's life, it's health. And we expect claims to be paid in a timely manner and a complete manner when we need that utilization. So my team of 25 plus people is there to kind of serve as that middle person mediator between the insured and the insurance company.
It sounds like Pennsylvania residents have a lot to be grateful for on this front. Just briefly, Secretary Spiker, when consumers are duped into sending money to fraudsters, I understand you've been known to say there's an extra layer of protection for Pennsylvania residents. Can you explain a little bit about what you mean? What's this extra layer of protection?
Well, one of the things that's incredibly important about Pennsylvania is consumer protection isn't new to us. And we have some of the strongest laws in the nation around small dollar lending. Specifically, if you think about it, payday lending, which is a horrible cycle of debt for consumers. Our usury law, APR, that can be charged on those types of loans is capped at 6%. When you think about it, when you're making small dollar payday loans, effectively that 6% cap has eradicated payday lending in Pennsylvania. And that's why I always say there's always been that extra layer at the state level, especially around that predatory basis. I can also tell you, vastly the majority of complaints that come in about banks and credit unions are pertaining to frauds and scams. And there's a new variation almost every week, whether it's a grandparent scam, a romance scam, or an inheritance scam. Time is of the essence. It needs to get to law enforcement. It needs to get to a bunch of different agencies at the same time. So our team is incredible. They work with our Office of Attorney General. They work with local law enforcement. They also make referrals to the FTC. They also make referrals to the FBI. but getting to the institution and getting to law enforcement is the best way on the back end that consumers can be protected.
Thank you,
also-
Secretary Spiker.
If I can also, I'm sorry, if I can also put a plug in, Pennsylvania believes very strongly that consumer protection in the financial space is not just about enforcement. It's also about education, because that's the front line for teaching consumers how to protect themselves, how to spot the scams. And we also have an incredibly nationally recognized team that does financial outreach education. And that, to me, is what makes Pennsylvania that extra layer. You've got the strong offense with the education front, and then you've got the strong defense on the the enforcement on the back end.
Thank you. Anna Odegaard, as a direct result of what's been going on at the CFPB, you and some others have decided to step up and offer Minnesotans the new Minnesotans for Consumer Financial Protection. So please tell us a little bit about what you're offering and what you're doing on the consumer complaint front.
Yes, thanks. Thanks, Ruth, and thanks so much, Consumer Action, for inviting us to participate today. I'm excited to share a little bit of the work we're doing in Minnesota, and it's great hearing about the really important things folks are doing in other states. So I'm directing a brand new coalition. It's called Minnesotans for Consumer Financial Protection, and we are working to unite nonprofits across the state who are committed to really centering consumer voices and consumer experience in all of the public policy conversations going on around consumer finance issues in the state. And for just a little bit of context, there had been a lot of different organizations, myself, working with some of those included, who had been working in a siloed approach to some different consumer finance issues. So I had been working real hard on establishing an affordable auto insurance program here in Minnesota. I've got colleagues who are working on homeowners insurance, who are working on establishing interest rate caps. But we were all doing that work separately and recognized at a certain level that we were really missing some opportunities there to leverage each other's networks, each other's policy expertise and relationships, and really also the momentum of campaigns when we were doing our work in a siloed way. And what that meant was, and I think this is true in a lot of places, that the public policy conversations around consumer finance in Minnesota at the state level tend to be dominated by representatives from industries who bring their expertise to the table. They're bringing their data to the table. And as a result, we end up with a regulatory landscape that is focused on a thriving market in the sense of profitable industry instead of really thriving and healthy, financially healthy communities. And we had there was kind of a catalyzing event last session where the Senate Commerce Chair reached out to several of us who had been doing some of this consumer protection action around the state because he was working on a bill that was related to consumer finance. And he asked us, can you guys maybe find us some consumers to come testify on this bill? And I think several of us had a similar response, which was like, it's not really how it works. I can't just pluck a consumer out of the air to come testify on your bill on Tuesday. But it got us talking about why we don't have that centralized approach in Minnesota. And the timing, as all of you know, also as we started talking about this and the CFPB was being dismantled, I think the timing was also right to go to funders around this issue in Minnesota. And so we kind of put together the model we wanted to use, and we talked to some funders, and we were really fortunate to be supported by the McKnight Foundation with just sort of a launch grant to put a consumer coalition together. So to give you the basic nuts and bolts, we're really working right now to build a coalition that is representative and diverse, which means, and like Ruth, you mentioned some of the populations we are more concerned about. So we really want organizations representing youth, organizations representing seniors, organizations representing maybe lower income workers who are working paycheck to paycheck, and make sure that those folks are at the table. We're also concerned about geographic balance. So we know that some of the issues facing rural Minnesotans might be different than those in the metro area. So really looking for geographic diversity. And then also diversity in terms of communities being represented, different racial communities, ethnic communities, and making sure that those folks are all coming together to talk about how consumer finance issues are affecting us differently. We have at this point defined 4 kind of focus areas that we want to work in. Banking and lending is the first one. And so for instance, the payday loan apps that are proliferating alarmingly here in Minnesota, I know elsewhere is one of the issues we'll be looking at. Our second bucket is insurance. So this has been mentioned a number of times on this call. Both auto insurance and homeowners insurance are issues that there are a lot of folks concerned about in Minnesota, and we'll be working on those. We'll be working in the kind of debt and collections area. There's been a lot of work on collection practices, protections around collection practices in Minnesota lately, specifically around medical debt, but not necessarily expanding those to other kinds of debt. And we are concerned about there being a lot of work to do there. And then the fourth bucket is really kind of fair competition and anti-monopoly work. So across those four focus areas, I think at least at the startup, this coalition is going to be working in three different activities. And I'm glad that there's been some mention of public education. The Secretary of Spicer just mentioned this. The first area really is community education, because we want to be building a broad and cohesive narrative across the state around consumer financial protection. And that's one of the things you can't do when you're working on individual campaigns separately. So that's the first piece, really partnering with our members, but also with our Attorney General's office and our Commerce Department, who are really interested in doing this work with us to really enhance consumer education around the state. The second bucket is really around accountability. And the way we're going to start that is by starting with a storytelling portal. There are official complaints portals, of course, on our Attorney General and our Department of Commerce websites, but they're not particularly user-friendly. And we've talked to both of those agencies. They both agree with that and are happy to have a community organization that will be routing stories that we hear to those portals when it's appropriate. But a lot of times, the story isn't somebody saying, I know this happened to me, I know it's a violation, and I know what law was violated, right? Like, that's not how it happens on the ground. So really having a storytelling portal that's more like, tell us what happened that felt crappy to you. And we then will reach back out and talk about, is that something we might route to one of those official portals? Is it something where we're building information about an emerging issue in Minnesota that may become an advocacy campaign? And as part of that, are you a person maybe who's interested in doing advocacy on this? If you felt motivated enough to share your story, do you want to get involved with an organization that is working for stronger consumer financial protections?
And we will talk more about the advocacy part just a little later. And for now, I wanted to turn to Commissioner Humphreys and turn briefly to the federal government shutdown's primary issue, which is Affordable Care Act ACA cuts. These tax credits that make the ACA and marketplace health insurance more affordable are expiring in December. Unless Congress extends these credits, insurance premiums, as we've said, will double, triple, and will affect everyone who has insurance that doesn't get it through their employer. In recent weeks, as Commissioner Humphreys mentioned, people are getting notices of these astronomical increases, and open enrollment starts November 1. We are talking, as you said, Commissioner Humphreys, that people may be forced to go without insurance. So it seems that states are going to have to choose between cutting services or contributing more to try to address some of this federal shortfall. What can you tell us Pennsylvania is doing, planning to do, to help residents maintain access and affordability if these cuts end up taking place?
Yeah, thanks, Ruth. And I know we talked a lot about this at the top of the hour, so I'll try to be brief. We actually, the insurance department, we have traveled the state and meeting people in community libraries to talk about what the rate review process looks like, to talk about what significant rate increases look like, and to walk consumers through the process and really drive home the point that it's important to shop, to talk to a navigator that can help work with you on exchange options, potentially talk to insurance brokers or insurance agents who may be able to connect you with other sources of coverage. DHS, who oversees the Medicaid program, is also putting information out from an education standpoint on what to expect, the importance of completing applications on both the public side and the commercial insurance side to make sure individuals remain eligible, and to better understand where that eligibility lies. Is it going to be through the Medicaid program, or is the eligibility with us on the commercial side through Penny. So I think there's a significant education component that continues regardless of whether Congress acts. But again, I can't say enough. We need Congress to act. Congress should act now to extend the EPTCs. That said, the administration, we will continue to work for Pennsylvanians on finding affordable options, expanding opportunities for individuals, and making information as clear as we can for Pennsylvanians on what opportunities are available for them across the markets.
Secretary Spiker, this period of significant federal rollback, some have said maybe a time for states to join forces and work together. Can you see that working in Pennsylvania? And if so, are there particular areas where you could imagine Pennsylvanians working with other states to make some progress on some of these issues?
Thanks, Ruth. That actually is already taking place, but I expect that to increase with what's happening in DC. So I think I mentioned before, we're a member of the Conference of State Bank Supervisors. We're also a member of the National, Credit Union Association Supervisors. So at the end of the day, they coordinate and collaborate with states on enforcement and examination. So for example, if we have a large national non-bank entity, we'll go in collectively, pick the state that has the most direct nexus and probably the strongest laws, and they will actually lead the examination of that particular entity with a team of examiners from various other states. And then once the examination and the enforcement is done, then the other states can also join in that enforcement. We've done that in the past. The states have also shared in some of the responsibilities in regulating and examining, for example, large third-party service providers to the industry. So not just the players in the industry, but the critical third-party service providers that typically provide most of the services that the community banks use. We do joint examinations there as well. The other key area that's probably critical, especially now, is around model law. For those of you who may be familiar, the federal government recently passed the Genius Act, and like everything at the federal government, it doesn't necessarily tell you what it's about. So for those of you who are unfamiliar with the Genius Act, it sets forth a federal or national framework around payment stablecoin issuers at the federal level. So the states now are working with CSBS to create a model law so that rather than passing 50 different laws in 50 different states, there'll be one model law that's actually used as the framework so that we have consistency among the 50 states. So there's no arbitraging. So the bad players or the industry doesn't go to the least regulated state in order to get its license. That's one of the things that's incredibly important. Now, the Genius Act clearly has still a lot of work to be done at the federal level. They've passed the act. There's probably be some additional amendments, but there'll also need to be regulations. So there is a tremendous amount of work that's being done behind the scenes by all the states collectively and collaboratively to be able to offer the state option.
In this area of stable coins. Understood. Thank you. I also want to be sure to mention that we're going to return to this whole issue of health insurance affordability and accessibility with Colin Roosh a little bit later in the webinar. He has a lot to say on this topic. In the meantime, I understand that both the Secretary and the Commissioner have a few other things to do today. So we want to thank you both for joining us, Secretary Spiker and Commissioner Humphreys. Thank you so much, and thanks for sharing what's going on in Pennsylvania.
Thank you for having me.
Thank you very much.
Sure. Next, I'd like to turn to some other states and city efforts that are going on. Some states and localities are trying to mirror some of the federal consumer protections that recently have been, unfortunately, abandoned by the federal government. California just passed enhanced data protection that's offering a universal opt-out. So that means that people can have it be automatically told to websites that consumers don't want their data sold or shared. California's also taken the FTC's abandoned click to cancel rule and made it their own. And that now makes it a simple, easy way to cancel subscriptions. And California has taken the FTC's CARS rule, which also is no longer federal, and even made it possible for used car buyers to actually return their car, if it's a lemon, within 3 days. So there are some states that are doing remarkable things to give us consumer protections while the feds are falling back. In New York State, lawmakers voted to improve the fight against deceptive practices. So the New York City Comptroller's Office has been strongly supporting UDAP, which is unfair and deceptive acts and practices protections. And Andrei Vasilyev, will you tell us a little bit about what's going on in New York?
Thanks, Ruth. Yeah, so the Fair Business Practices Act is what the legislation is called. It really aims to be a major overhaul of New York State's consumer protection law, General Business Law, or GBL 349, which is widely considered to be one of the weakest consumer protection laws in the country. And I'd argue the legislation passed in June and awaits Governor Hochul's signature, who will hopefully make a decision, will make a decision by December. The centerpiece of the bill, I would argue, and is really around this, as you mentioned, these UDAP provisions. So what UDAP refers to is, so the vast majority of states out there have at least statute that prohibits businesses from engaging in unfair or deceptive acts and practices, which is known by the acronym UDAP or UDAP. The Dodd-Frank Act, in establishing the CFPB in 2010, also added this abusive protection, which extended the acronym to UDAAP. Most states still don't have protection against abusive practices, although I believe California and Maryland have already added that to their statute. On the other hand, New York State's current general business law only prohibits deceptive acts and practices. So what do those terms mean and why do they matter? Well, they can significantly impact the scope of what prosecutors and consumers can enforce against when it comes to unethical business practices. So simplifying the definitions a bit, deceptive, which is what New York prohibits, refers to things that are materially misleading. That could be something like bait and switch advertising or substantially misrepresenting a product. Unfair or sometimes unconscionable refers to causing substantial injury to consumers. So this is where you get into things like excessive fees, surprise overdrafts, charging customers for add-ons to some service that they didn't sign up for. And finally, abusive, arguably the broader term of the three, generally refers to something which interferes with the customer's understanding of the terms and condition of a service or takes unreasonable advantage of a customer lack of understanding of these terms. So this could be things like steering student loan borrowers into more expensive repayment plans or taking advantage of someone's limited English proficiency. So the Fair Business Practices Act would add both the unfair and abusive standard to the state's UDAP law, and therefore allow the New York State Attorney General to enforce over a much wider range of harmful business practices. Outside of UDAP, there's a couple other major weaknesses in the law that the Fair Business Act addresses. For one, it would remove the requirement that a particular business practice be consumer-oriented in order to count as a violation, which means that the plaintiff currently has to prove that the harm they experienced is part of a broad pattern that affects many consumers and wasn't just inflicted on them. The act also extends UDAP protections to not just individuals, but small businesses and nonprofits. It raises the maximum penalties per violation from just $50 to $1,000. And potentially probably the most contentious part of this law is it expands the New York State Attorney General's authority to enforce consumer protection, not only over New York State companies operating in New York, but out-of-state companies operating in New York and the operations of New York-based companies in other states. So assuming the law passes, this is almost certainly going to be litigated extensively in federal court, and we'll see what happens there. But in any case, the act is a huge step towards modernizing New York's consumer protection law.
Great, thank you, Andre. And there's also, the Comptroller's Office has been supporting a New York restitution fund, right? The CFPB used to refund consumers. I said $21 billion was returned to consumers. Can you tell us a little bit about the Comptroller's interest in the restitution fund in New York?
Yeah, absolutely. So this is something our office recommends, which unfortunately is not part of the proposed Fair Business Practices Act, would have to be legislated separately. But one important innovation, as you mentioned, of the CFPB that I think isn't as widely discussed is their establishment of something called the Civil Penalties Fund. And what that fund did is it took a portion of the civil penalties that a court will impose on a business that's violated the law, in addition to the direct restitution to consumers, often civil penalties involved, takes a portion of those, plus any unclaimed direct restitution payments, puts that into a fund that will pay out consumers in future cases where their restitution can't be recovered from the defendant for whatever reason. So this is really important because it allows consumer victims of fraud to be compensated for their losses when either A, the defendant has become insolvent and their assets can't be recovered, or simply the scammer in question is unable to be traced. With the CFPB's Civil Penalties Fund, it seems like has been fairly successful to date. To almost 7 million American consumers, has paid out over $3.3 billion that they would have otherwise not received in restitution. Very administratively efficient as well. But now with the new orientation of the CFPB, there's of course signs, like with many other policies, that there's attempts to severely limit the extent to which this fund will operate. So in New York, I believe, so California and Minnesota have already set up their own consumer fraud restitution funds that work in a lot of ways similarly to the CFPB's. And this is our recommendation for New York State as well, because it is ultimately a fairly straightforward policy, not necessarily to implement, but kind of by design. You're setting up a fund to receive a portion of civil penalties that courts already impose in consumer cases, and it could help recover hundreds of millions of dollars for New Yorkers who are harmed by unfair, deceptive, abusive practices and wouldn't otherwise be compensated for the losses.
Thank you, Andre. So, Conf, there are other cities stepping up to strengthen consumer financial protections. Can you tell us about what's going on in some of those other cities?
Yeah, and just for a little background, a lot of what we pay attention to is to think about what happens after all of the advocacy work that a lot of great organizations have been doing, is the infrastructure to really implement and enforce these laws that get passed. And what we found over a long time is that the infrastructure is largely degraded at the city and county level. So just for a real quick fact, in 1974, there were 180 cities and counties with active consumer affairs departments that focus on consumer protection. There are now 18 or less in 2020. So this is the big challenge that we've been focused a lot on. And so over the last several years, we've been trying to cultivate more cities to start thinking about how do you re-engage in this space and be complements to what's happening at the state and federal level. And particularly now more than ever, with the federal level being basically dormant, there's an important role that cities and counties can be playing in creating a layer of protection that is very, very much needed. So at the city level, we've seen some successes where, for example, in Baltimore, who's done a lot of great work. They really recognized that they could, there was an opportunity for them to really step into the void, and they recently passed, this is now about 2 years ago, an unfair, deceptive, and abusive practices act, modeling kind of what you were talking about, Andre. And then as a part of that, more recently, they passed an ordinance to establish a new consumer protection agency that is designed to not only explore and take in complaints that are potentially violations of their UDAP, but also of their business licenses that they, for now, have only been doing compliance, but now can think about it as a much more robust effort. But one of the things that they really wanted to pay attention on is, since they passed their UDAP, is thinking about the way the cities could really proactively go after some of these businesses that have been problematic, using their litigation, affirmative litigation potential. And so you've seen great cases that have come out of Baltimore. One, certainly getting restitution for people who were dealt with opioid advertising and problems that resulted from there. They've filed lawsuits against DraftKings for deceptive fees related to online sports betting. They went after ghost gun providers, and more recently, they've also gone after a payday lender called MoneyLion. And it's really about leveraging their independent authority to file a case in state court, and not waiting now for the CFPB or one of these others to sort of step in the fray, which they probably won't. And this is the kind of activity that we think more and more cities can be doing. And the reason why we think that is when a lot of those previously 180 places who had robust consumer protection work started to go away, some of those laws didn't go away. Some of them still exist on their books. And so part of the process is kind of dusting it off. So if you look at a place like St. Paul, Minnesota, if you go into their municipal code, they have a ban on deceptive trade practices in their municipal code that goes unenforced, partly because they have zero infrastructure or any internal knowledge for how to do that. But the opportunity exists, and so that's kind of what we want to sort of help cultivate, is that there's an opportunity for cities to jump in and identify and go after those issues. So just a couple other examples. Albuquerque identified paid tax preparers as a challenge for a lot of consumers, particularly around pricing and not so transparent pricing and fees. So they created a mechanism where they require mandatory disclosures, and also whether they're actually qualified to be preparing taxes. In Denver, they found that there was a lot of contractor to subcontractor wage theft, which they received a lot of complaints about. And over time, they created a new law to combat that, and actually have an enforcement mechanism through their auditor's office that is going after these businesses that are not paying wages that these folks were being promised, and also potentially taking advantage of people's vulnerable immigration status. So, and there's more and more that are happening. But one of the things that we think are particularly right now, because it takes a long time for some of this sort of legislation to pass, the opportunity to leverage existing authority, whether it's if the city has a UDAP or public nuisance or some other anti-discrimination law, to think about how you utilize those laws proactively and to protect consumers. We think that's a really important opportunity. And then along the way, recognize the importance of also being able to have listening mechanisms about what's going on in their communities, what kinds of issues are happening, and to be able to take them in and respond, whether it's them themselves or partnerships with the state or some other enforcement authority. The city's role is really powerful to be able to be kind of eyes and ears and potentially respondents in a meaningful way.
That's very encouraging. Thanks, you, Conf. I promised we'd return to health insurance affordability, accessibility. So I think we'll do that now. These painful reductions in ACA healthcare subsidies and cuts to Medicaid all come from drastic cuts made in the budget bill that Congress passed earlier this year. Some called it the Big Beautiful Bill, others called it the Big Brutal Bill. We do know that these cuts will be disastrous to families, to individuals, to rural hospitals. And estimates are that millions of low-income consumers will lose Medicaid coverage. Millions more will lose health care through ACA and marketplace cuts, or will become uninsured. Organizations like Community Catalyst have been fighting to reverse these drastic cuts since Congress passed them. So Colin Roosh, please tell us how you expect this to play out for millions of Americans.
Yeah, so, you know, as we kind of started it on with Commissioner Humphreys, you know, we're looking at some very immediate impacts in terms of healthcare cuts and affordability concerns. But I think, you know, over the next 10 years, we're looking at sort of a double or triple whammy on that front. So most immediately, if the ACA's enhanced premium tax credits are not extended by Congress, we're looking at about 4 million people who will lose health insurance as a result, and, you know, 20-something million people who will see skyrocketing premium costs. And, you know, that's coming at the same time that we're seeing double-digit premium hikes across all states for 2026. And I just want to note that, you know, the enhanced premium tax credits built upon the ACA's infrastructure for supporting people in purchasing affordable and comprehensive health insurance. It's made low or no cost healthcare plans available to tens of millions of people over the last decade. On average, it's saved, you know, the average person about $700 a year in health insurance costs. And we estimate that, you know, for 2026, if they are extended, you know, that savings will jump up to well over $1,000. But, you know, that varies significantly from person and household to, you know, from person to person, household to household, and state to state. So, you know, we've got a number of states that will see premium costs for people well more than double. States like West Virginia, Wyoming, Alaska, Tennessee, Mississippi, Texas, South Carolina, Alabama, and the Dakotas will see, you know, those premium costs, you know, double or triple. And just to give a couple of examples, you know, a family of 4 in West Virginia making $62,000 a year will see their health insurance costs go from about $90 a month to well over $300 a month, looking at a 267% increase in their health insurance costs. A 45-year-old earning $20,000 in a state like Alabama that hasn't expanded Medicaid would see their premium payments go from $0 to $420. And an average 60-year-old couple making $85,000 a year would see their annual premium costs go up by over $22,000 a year. And on top of that, we've got healthcare cuts that impact, you know, our most vulnerable communities, low-income communities, communities of color, rural communities, and immigrant communities. So many lawfully residing immigrants, including refugees, asylum seekers, some green card holders, victims of human trafficking, will next year, come January, be ineligible for premium tax credits altogether. They'll be ineligible for Medicaid and Medicare coverage. And that's at the same time that states are staring down the barrel of significant reductions in overall Medicaid financing, restrictions on mechanisms like state-directed payments and provider taxes that have allowed most states to bolster their Medicaid programs in general and direct payments to high priority providers. So over the course of the next 10 years, that's like 15 million people we're expecting to lose coverage. Sorry, I'll pause.
I'm wondering, so what can states and cities do to protect citizens? Where do we go?
Yeah, I think in the immediate term, we've heard folks speak about information, and I think that's absolutely true. States, localities, and agencies need to be actively communicating about these policy changes, setting expectations for what people are going to see come November 1st when they're shopping for coverage, ensuring that people also know about deadlines for opting out of auto enrollment, and thinking about how to direct them to additional supports, whether that's financial assistance, navigators who can help them, work their way through the enrollment process. But I think also providing information and guidance that says, if you see sticker shock when you're shopping come November 1, there's still hope that Congress will extend these premium tax credits. So maybe, take a breath, come back a little bit later during the open enrollment period. But don't give up hope. What we don't want to see is people opting out of coverage altogether, and then at the 11th hour, Congress passes an extension and people don't come back and purchase coverage. But I think we can also be in states that operate their own health insurance exchanges. They do have broader flexibility in terms of enrollment supports, open enrollment periods and special enrollment periods for instances like this. There are some federal restrictions in place on open enrollment periods, particularly for low-income individuals, but states that operate their own marketplaces can, go above and beyond, federal standards to make sure that people have ample opportunity to enroll, re-enroll, or reevaluate their coverage options.
So contact your legislatures, let them know how upset you are, and keep going back and checking to see if premiums have been reduced from the extraordinary increases.
Yeah, and I think what's hard on this front is that the premium rates are already set in place at this point in the game. So there's not a lot of opportunity to adjust that. Some states like Maryland are setting up a state-funded program to help fill the gaps in those subsidies. New Mexico held a special legislative session to try to figure out how they can broaden flexibility for the use of their affordability fund to that end. But not every state has the luxury of a windfall that they're sitting on that they can direct towards this.
Right. Thank you, Colin. Now let's turn to insurance issues on another front. I'm talking about homeowners insurance. Natural disasters and climate change are wreaking havoc on homes and on our homeowners insurance system, leaving millions in states like California, Florida, and elsewhere with utterly unaffordable premiums, and in some cases, no coverage at all. These rate hikes affect renters, homeowners, and those who are developing new housing. So, Doug, from escalating premiums to unavailable coverage to last resort programs that need a fix, property insurance for consumers and communities is, these concerns are pretty overwhelming. So, Doug, please help explain this mess, would you?
Sure, of course. So over the last 2 years, Consumer Federation of America has been diving into a few large data sets that reveal the problems from kind of a micro level to a macro level. And just very quickly, our most recent report we called Penalized found that homeowners with below average credit scores pay double the amount in premium for the exact same insurance coverage as homeowners with excellent credit scores. And this, by the way, also goes for drivers when it comes to car insurance. And people, of course, have no idea that their credit history is what is driving their home or auto insurance because there's no credit risk related to insurance. If you don't make a payment, you're canceled. So this is a real problem. And at the micro level, this is really making insurance difficult, especially for lower and moderate income communities. I mean, for all sorts of social, economic, and historical reasons, credit scores correlate closely with race and poverty in America. Now, our overburdened report revealed that in a 2.5-year period from the end of 2021 to the middle of 2024, homeowners insurance premiums jumped on average more than 20% across the country, and in some states over 50%. So you're having people who are already struggling financially dealing with not only their mortgage payments and their taxes, seeing these escalating monthly homeowners insurance premiums, which is really making it difficult just to maintain that coverage. And our exposed report actually sort of saw this in kind of really play out in the marketplace, because we found that about 6 million homes in the United States are completely uninsured. This represents about $1.6 trillion in market value. And these are not wealthy or expensive homes that wealthy people are just deciding to take care of on their own with their own funds. What we found is that these uninsured homes are concentrated in communities of color, low-income communities, rural homeowners, and the owners of manufactured homes. And as a sign of how this is getting worse, just yesterday, a financial ratings firm issued a new report that the insurance industry is non-renewing homeowners insurance policies at a rate that is 190% higher than just in 2018. And so you have this sort of growing crisis from the individual homeowner who, because of their credit history, can hardly afford the home insurance, multiplied by all the escalating prices. And we see it play out with this incredible amount of people who are going bare. And that leaves individuals, but also communities exposed to really a systemic crisis where we have our primary assets being completely unprotected. But another piece of this, just very quickly, is that despite all the attention on the kind of horrific and explosive wildfires we've seen out in the West and the hurricanes that are given names so we remember them, the vast majority of catastrophic losses around the country are from severe windstorms and hailstorms, by an order of magnitude 10 times more insurance claims payments due to hail and wind catastrophes than wildfire or tropical storms. And those are happening from the Rockies to the Appalachians, from the middle of Texas to the Canadian border, so right in the Midwest. And so that's one of the reasons that we've seen the most dramatic explosion in premiums in the middle of the country, even though all the conversation is about California and Florida and the like. And I think that there's also another reason that there's been so much pain in the middle of the country, which is a lot of the states have very weak regulatory oversight of the insurance industry. So we have all of these sort of all of these problems that are coming together at once that is really making our homeowners insurance market lead to home ownership becoming unsustainable, especially for lower and moderate income people. And then you mentioned that, just as a way to wrap this up, it's not just homeowners who face that burden. So renters are feeling not just the price of their own insurance, which very few renters, especially lower income renters, even buy, but they're feeling the pinch of affordable housing developers who can't find insurance in the market. So they're not building as much, or they're seeing their own premiums jump from $60,000 a year to $300,000 a year, and they can't pass that on to their renters, so they're in a lot of trouble. Or where they are allowed to pass through some, the renters are seeing spiking rents to cover this insurance. So we have a situation where you have this product that is at a critical juncture in the economic sort of process in our country that is becoming unaffordable, and it really will have this knock-on effect toward our housing system, which is already in such a state of crisis. So I think that all of those things point us to needing to not only look at reforming our markets, but thinking about reimagining homeowners insurance and the broader property insurance market entirely.
So can you name one or two things that how you would reimagine this?
Yeah, well, I mean, there are so many different pieces of this, but one of the things that we do want to see, and this is actually, I wouldn't call this a reimagining, but as a kind of an immediate part of this, which is we need to be investing in infrastructure. At the end of the day, the single best way to reduce the cost of insurance is to reduce the risk associated with the properties. So we see, like in states in Alabama, the state is puts up $10,000 grants for people to put stronger roofs on their home, and when they do, they qualify for a discount on their homeowners insurance. So when you reduce risk, when you invest in infrastructure, and homes are infrastructure, but also other sorts of infrastructure that will protect against flooding and wildfires, for example, then you can help reduce the cost of insurance and the strain on communities. But we also have to recognize that with climate change exploding our risk here in the United States and around the world, we have to find better backstops for the market itself. When we had the tragedy of 9/11, the commercial insurance market seized up because insurers and the big reinsurance companies that help protect the insurance industry around the world, they said, we don't want to do anything with that provides coverage when there's a terrorist act. Immediately, Congress put together a backstop for the market to make sure that Wall Street could rebuild. And yet we have not done anything to make sure that Main Street is protected. So we should be building a reinsurance program in America that doesn't rely on global unregulated reinsurance corporations and instead says we're going to protect our own market and our own communities. So that's another way to build. There are, of course, so many different ways to do this. And I think that we need to, at the very least, begin the conversation that says, just because private insurance companies want to keep the old system that allows them to slice and dice and price people however they want and walk away from communities that have paid in for decades, doesn't mean we have to do it that way. We can imagine an insurance market that really looks at the collective wisdom of insurance in its initial construction and think about doing it with an orientation towards consumers rather than companies.
Terrific. Thank you, Doug. Thank you. That's very inspiring. Anna, could you just very briefly explain your hope to offer advocacy training to consumers and to direct service organizations related to all this homeowners insurance mess?
Sure, definitely would love to. I mean, I think it gets back to what we're trying to do with MCFP, which is really building a common narrative and building political power across the state for the long game in homeowners insurance, but also all of the other issues that have been mentioned today. And what that takes is building leadership and advocacy capacity within impacted communities. And that's important. I mean, I think it's important as a principle, but it's also very practically important in the sense that you need folks that are closest to the problem involved in issue cutting and policy development, so that we're building campaigns that are actually addressing, around policies that are addressing the problems correctly. And also, I have done a lot of advocacy lobbying in my life. I imagine lots of folks on this call have. And so I really know the difference between talking to a policymaker as an advocate and talking to a policymaker as an advocate who is partnering with someone from their community, from their district in that meeting, who is actually doing the work of explaining to the policymaker, often their state rep or their state senator, why is this issue important in my neighborhood? And they know that neighborhood, right? They can talk about the same Main Street. They can talk about the businesses that are impacted. And so it's really just more effective to do the advocacy in partnership with folks that are experiencing the issues. So what I've done in the past with other organizations and what we're building with MCFP is really a partnership with primarily direct service providers, where there's, for instance, a program that is connecting folks with affordable housing or doing workforce development. So they already have built kind of a safe home for individuals who are seeking a certain kind of assistance, and they have some trust relationships with those folks. And they're really positioned better to invite people into an advocacy space than, say, I am, in St. Paul, spending most of my time at the Capitol. And sometimes we call it kind of a hinge model, where we really need a partnership between folks that understand the system in St. Paul and have relationships there, and the folks who really understand the systems and what's happening in communities. So some of the things we do are really try to identify what are the barriers to or the hurdles for impacted communities to get involved in that advocacy. And they are almost never, a lack of interest. But it's really more practical things, like, do they know what are the entry points in an advocacy campaign where their story is going to make the most difference? But also, do they have somebody they trust who's going to help them understand the system and do the training and meet them on the steps of the Capitol, so they're not, doing the work alone? And so a lot of what we've done is really having our advocacy folks partner with somebody like a program manager at a nonprofit who may be running a financial capability group, or they may be running a Head Start parent policy group, someplace where they've already built some community with a community that is vulnerable to some of the, whether it's high auto insurance rates or homeowner insurance rates or whatever it is. And somebody from our organization, sometimes it's me, will come in and do a legislative advocacy training to begin with, just helping people understand the system. How do we go from a complaint, right, to a policy, to actually moving a policy and creating some change at the state level. So doing that training so that we have some relationship, and then going from there to invite individuals into working with the campaigns and building those relationships.
Terrific. Doug, So we've got folks who simply can't afford insurance. We've got others who have been dropped coverage-wise by their insurer, which seems to hurt everyone in the long run. What do consumers do? Are these fair plans? Are these plans, last resort plans, helpful? What do they do? What do we do?
Yeah, I mean, so first of all, I want to say we can't just put the burden of solving the insurance crisis on individual homeowners, renters, drivers, and that's one of the things I think the insurance industry likes to do is say, well, you can go, if you get canceled, you've got a fair plan, or there's this thing called the surplus lines, which is kind of a weird part of the insurance market where you may be able to get a policy, but it has no protection, no backstop, and it's out there. And so, I mean, part of this, and what I was talking about earlier, is we do have to be thinking about systemic responses to this, public policy responses, the work that Consumer Action, Consumer Federation, and the Minnesota Consumer Financial Protection, all of us will be all working on. But at the home, as a homeowner, you do still have to have that insurance, because if you don't, your lender is going to go buy a policy that's very expensive, that doesn't protect you, and then they're going to charge it to you on your mortgage bill. It's called forced placed insurance. You have to have that. So we have these insurance markets of last resort. In most states, they're called fair plans where they exist. And that's going to give you a kind of a bare bones homeowners insurance policy at a high price. And you want to have something better than nothing. So you can go and search for that. But I also think that we have to be spending a little bit of our time as homeowners, and perhaps more importantly, as local organizations, getting in touch with our regulators and our lawmakers and saying, hey, you need to be looking out for us, because I just don't think that the insurance regulators and the lawmakers have been paying so much attention to exactly how that crisis plays out at home when people get those non-renewal notices or see those spiking premiums. I wish I could say, well, the easy thing to do is just increase your deductible. You can increase the deductible on a homeowner's policy. You could get rid of your comp and collision coverage on your auto insurance policy, and that will save you some money. Is it going to save you enough to not be in financial crisis? Probably not, but what it is going to do is it's going to expose you if ever that disaster does strike. So we want to be really careful when we take on more risk, and to lower our prices, we're taking on more risk. We're putting ourselves in a more precarious financial position. So there are some things we can do, but I really think that this is going to be a public policy solution. And I'll tell you one thing that I think is really important. The crisis that people are feeling when they're looking at their homeowners, or affordable housing developers are looking at their costs, that is a real crisis on the kind of demand side, the consumer side. But last year, 2024, the insurance industry as a whole nationally brought in $170 billion in net income. They distributed over $80 billion in dividends to their shareholders. They spent over $12 billion on advertising. So they and their executives, the top CEOs at the top 10 insurance companies in America, got paid over $130 million in pay in 2024. So this crisis that we're all shouldering has been an absolute boon for the insurance industry. So yes, we have to do some things as consumers, and our community groups can be informing and educating consumers about sort of where the opportunities are, how to be careful. But this is going to take something more than that. This is going to take organizing and advocacy in order to reform this market. And unfortunately, that's where we have to be focusing our energy.
So one of the folks who are listening to everything you're saying is asking, are we better off just going without insurance?
No. I mean, I'll answer. I'll answer that. I think, especially for somebody who has most of their financial wealth, for a homeowner perspective, is in their home. That's the chance that they have, something that maybe was passed down to them. And if that is exposed, and we saw this unfortunately in the Maui wildfires a couple of years ago, where you had a lot of homes that had been passed along from generation to generation, but because insurance premiums had gotten so high, they couldn't afford the coverage. And when it burned, they lost that generational wealth, that limited access to wealth that people have. And also, the only way you can go without insurance on homeowners is if you own your home outright. If you don't, you're not going to go out without insurance. You're going to pay for somebody else's insurance, your banks. It won't cover anything for you, but you're going to pay for it still. And when it comes to driving, you know, if you're uninsured driving, you're subject to all sorts of fines and fees if you're ever caught, let alone the fact that if you do have a crash, you won't be covered. And so, just as an example, in California, going back 25 years, we created a program for low-income drivers to access a bare bones auto insurance policy so they would not be bare like that. And because of the auto insurance premium crisis that we're seeing around the country and here in California, where I'm based, we actually have seen an explosion in participants. But right now, there are over 63,000 Californians who are low income, safe drivers who likely would be uninsured but for this program. And that's great for them, it's great for the roads, but it's also a reminder that you can't ask people to solve this huge corporate crisis on our own, and we need that intervention. But we should not have to go uninsured, you know, at this time, and I would urge people to look for better ways.
Thank you. Kanth, we have a question from someone who's listening who says, is your organization working to reestablish some of these consumer protection agencies?
That we are, and we're doing this in a few different ways. So in the past, when we've had a few more resources, we were able to provide kind of direct financial grants plus technical assistance to kind of go through almost a restart for what does consumer protection look like at a local level? What are the functions and what are the opportunities and laws that are available? So really going through like almost a one-on-one like strategic planning process. And so that is work that we kind of continue to do on a in-kind basis, but we also host events targeted to local government, focused on kind of sharing of best practices. We have an annual convening, things like that. But hopefully in the future, as we develop more resources, we'll be able to do a lot more sort of direct technical assistance as well as funding to support that infrastructure building.
Thank you. Colin, I want to just very quickly touch upon medical debt for a moment. You know that the CFPB had a rule that was banning medical debt from credit reports. And you also know that that is no longer the case. A court has thrown that out, struck it down, and the current CFPB has opted not to fight that. But there are 15 states, I believe, that actually have enacted their own bans, which may or may not be at risk. Now, tell us very briefly about that. Can you touch upon that?
I'll just say, you know, we're seeing significant progress on the medical debt front at the state level, more so than ever in the last year or two. So yeah, more than 15 states now are banning or taking action to ban medical debt from credit reporting. I think Delaware's policy just went into effect this week. I will note, however, that in addition to the CFPB rule being struck down earlier this year, the CFPB just this week, I think, issued an interpretive rule stating that you know, federal law preempts state law with regard to what can go on credit reports. So you know, it's not like currently something that is being enforced, but I think it does sort of open up some of these state laws to future litigation, unfortunately. But you know, even beyond credit reporting, many states are taking additional action on medical debt, whether that be bans on wage garnishment or debt collections against low-income patients, as we've seen in New York and New Mexico, standardizing and strengthening hospital financial assistance policies and setting, you know, income standards for who must be screened and eligible for free care or reduced care when they can't afford it at the hospital. Something that, you know, we've seen action on across many states, including Illinois, in the past year. And we even just saw a medical debt protection bill introduced here in Ohio, my current home state, that would prohibit wage garnishment, cap interest rates on medical debt, and prohibit medical debt from landing on credit reports. So I think this is a great example of an area of consumer protection policy that is increasingly enjoying bipartisan support across the country at a time when, you know, much of our policy and politics feel incredibly divided.
Thank you. And Anna, we've got about a minute for you to tell us if someone else would like to set up an organization like yours in their state. Can you very briefly tell us how they might start?
Well, I would say, first of all, please reach out to me. I don't know if Ruth is sharing emails, but let's talk about some of the things that we did to get started. I think it's, there's not a cookie cutter version, but I think in terms of reaching out to a diversity of other organizations and making sure that you're prepared to explain how different consumer finance issues affect different communities. So you can really tie in with the work that, say, a housing organization or a childcare organization is doing. How does it affect the community, the families that they're serving? I would definitely be happy to have a conversation with anyone who wants to talk about approaching funders, what kind of funders out there are interested in supporting this work. And I think that that interest is expanding as there are folks out there recognizing that really the dismantling of protections at the federal level is going to require states to step up. And then I would love to talk to anybody who's interested about advocacy models, and especially, really inviting impacted communities into advocacy efforts, I think is an incredibly important part of this work. And so would love to have that conversation with anybody who's interested.
Thank you, Anna. So I want to thank each of our excellent presenters for helping us better understand what state and local protections we can count on when our federal government is falling back. Thank you, Kampf Desai, Doug Heller, Anna Odegaard, Andrei Vasilyev, and Colin Roosh. And thank you all for joining us today. We hope you found some of this information valuable. I want to add a big thank you to my colleagues, Nelson Santiago, Robert La, and Rick Perez. As Nelson said, this convening is part of our anniversary, 54th anniversary. Nelson's going to come on in one moment to wrap this up. I'd like to say, if you would like to help support consumer action, our free webinars, our in-person trainings, our multilingual publications that we all create, you can go to consumer-action.org and make a contribution. And from my end of things, I'll say thank you so much, all of you, for joining us today. Nelson?
Thank you, Ruth. And thank you, Colin, Kant, Douglas, Andre, and Anna for hanging until the bitter end. And we had over 300 people listening, or right around that number, for the webinar. So thank you for hanging into the bitter end. I do want, like I mentioned earlier, and actually I do want to say, if we didn't get to a question today, feel free to email me. I email you guys all the time, so you can email me all the time too, or email Ruth. We can get any of your questions to our speakers, and I'm sure they'd be happy to connect with you in the future. So definitely let us know if we need to address anything else. And like I mentioned, today is a day-long celebration of our 54th anniversary. If you're in the DC area, hopefully you've seen the invite already, but if not, reach out to me and we can make sure to get you into our event tonight. We will be giving a Consumer Excellence Award to Congressman Jamie Raskin, to the Consumer Federation of America. I don't know, Doug, if you're going to be there. Susan Tompor of the Detroit Free Press. And then a special recognition will be awarded to Deepak Gupta from Gupta Wessler LLP, and Susan Diegelman, a longtime friend who was with AT&T for a long time. So hope to see folks there. And also, we always remind folks we are a nonprofit. If you want to make a contribution to support our work, you can use the QR code here on our screen, or just go to our homepage and click on the button that says support us. So thank you so much. Ruth, if you had anything else, otherwise, I think we can close this out. Thank you all. Watch your inbox. Several more webinars coming and in-person events coming to a city near you soon. Thank you all, and see you again soon.
Thank you.